Hey, welcome back to Overnight Accountant's course on Realtors and reducing taxes, where we are working hard to help you as a real estate agent pay the least amount of taxes you possibly can legally. So thank you for watching our course and welcome back. Now in this section we're going to get a little complicated here. We're going to try to keep the complication to a minimum, but we're continuing our auto series, which is line 9, car and truck expenses, and we're going to be discussing auto depreciation. Now what I can say about this right off the bat is this is a very complex and confusing topic. In any area of tax code specifically, or in particularly autos, cars and trucks, this is very complex and very confusing. However, depreciation is calculated and reported on Form 4562, depreciation and amortization. This is an area, no matter how you're preparing your taxes, either whether you have a preparer doing it because you didn't give them the proper information regarding your vehicle when you purchase it, hopefully they ask, but primarily when you're preparing this on your own, if you're using your own software to prepare your tax return, this is an area where many errors occur, and the IRS knows that also. Therefore, we do highly recommend that you get a professional instead of using software if you are claiming auto depreciation on your tax return. Actual expenses in general on an auto really aren't that bad as long as you're really good at record keeping and understand how to enter it into the software. However, if you're taking actual, as I'm going to mention in a minute, you have to depreciate the vehicle, and that's where folks really run into problems. If you are seriously interested in depreciation, at some point we will probably have a separate course on auto depreciation. This may be a basic training course for people entering into the accounting field. But if you're really interested in it, check it out. It may help you if you're one of those kind of folks who just like to know everything about everything. You might be interested in watching that course. This course, however, for real estate agents in this auto section, we're only going to discuss the basics, and we're going to provide you a brief overview, the information I think you need to know primarily with regard to your business and taxation and the use of your vehicles in your business. Now, if you use actual expenses the first year that you place a vehicle in service, you can't switch back to standard mileage later. So you can't take the standard mileage rate later if the first year you put the vehicle in service, you claim actual expenses. Also, if you use a standard mileage rate the first year, which will allow you to switch back and forth in later years, you can only switch back if you use what's called straight line depreciation to depreciate your vehicle after year 2. You know, you claim standard the first year, and then other years you're claiming, if you do actual, you have to use what we call straight line depreciation, which we'll discuss here in a second, in later years. And here we go. We're going to go over some definitions. The first one is going to be what I just mentioned. That's straight line depreciation, which you need to use for your vehicles if you want to switch back and forth between standard. Just as a preface, there are all kinds of depreciation. There's modified accelerated. There's many kinds. Straight lines is one of them. There's acres, makers, whatever. We're going to discuss here is what's called straight line depreciation. This is basically where you expense the asset in equal increments over each year. Well, what do I mean by that? Well, basically for vehicles, it is 5 years, which we want to do on a monthly basis because you may not purchase your vehicle in January 1st. You're probably going to purchase the vehicles in different months, so we're going to take that vehicle. Say your vehicle costs $25,000. We're going to divide that $25,000 by 60, and therefore each month after you place the vehicle in service, you're going to be able to deduct $417 per month. Say in the first year you only had the vehicle for 6 months in service, you're going to be able to take half of that $417 rounded. But in later years when you have it the whole year, you're going to be able to deduct $5,004 of that. Now let me say this though too, with regard to this. Remember, all your deductions are based on your percentage of business use. So if you only use your vehicle, 80% of the miles on the vehicle is for business use, of course you will only be able to deduct 80% of that $5,004. Professionals are going to know that. Hopefully if you key everything in correctly in your software, it should get that correct too. Let's do a definition on bonus depreciation. What bonus depreciation is the ability to write off a percentage of qualifying assets, those that qualify for bonus depreciation, in the year of purchase. So this is a special part of the tax code that Congress enacted mainly to stimulate the economy a few years back, but they've kept it around. It's the ability to write off percentage of qualifying assets in the year of purchase. However, this is limited on most vehicles. Okay, and bonus depreciation is something that usually it's automatic if it's a qualifying asset. So if you're using software, you need to make sure you're very careful in how you enter these things, because a lot of times the software is not going to be very, you may not understand the questions it's asking you if it's asking you those questions at all. Which we have limits on most vehicles are limited with regard to this. It only applies to new assets. So if it does apply to your vehicle, it's only going to apply to a new one. Now it changes every year, as I'm going to show you right now. Not every year, but generally it changes on the whims of Congress. Sometimes it changes retroactively. Currently, 2017, it's a 50%. So if you bought something for $10,000, a qualifying asset, you have the ability, or you will write off $5,000 of that plus a little more depreciation in the first year as what we call bonus depreciation. As you see, it declines each year, 40% in 2018, currently 30% in 2019. However, that is likely to change at the whims of Congress. So take these items here with a grain of salt, and we just have to see what happens. You have to look that up to see if you're really interested in it. Changes regularly, as I just said. Okay, final definition here is going to be 179 expense. Now what this is from section 179 of the tax code, and that is the ability to elect. Now you see you have to elect this. You actually elect it by claiming it, but it's the ability to elect to expense a certain amount of a qualifying asset placed in service during the tax year. So this is kind of cool. It does have limits, which we're not going to go over the limits because they change every year too, just let you know what it is. But usually it goes from somewhere between $25,000 up to $150,000, depending on what Congress decides to do that year. But let's say you get to elect how much you get to write off if the asset qualifies. So for example, let's say you bought a truck with over a 6-foot bed that you're going to use in your business. You pay $50,000 for it. Because the tax rules, you'll find there's really no limit on that. So you could actually potentially write off that whole truck that you paid $50,000 for. The first year, of course, limited to the business use percentage. So anyways, or you could elect to write off less than that. You could purchase a net qualifying asset for $10,000. You elect first year. You can only do it the first year. So you only want to elect $3,000 of that as a 179 expense. You can do that. Then the remainder is depreciated over the life of the asset. So regular rules. It's also limited on most vehicles. So this is where it gets really complicated. However, both new and used assets qualify for the 179 expense. As I've said several times, it changes regularly. So if you're really interested in taking it, you need to keep updated on what the 179 expense rules for that year. For most realtors, it's really not going to come into play. It's only if you're claiming actual expenses. And if you're going to be doing this, I highly recommend, if you're buying an asset, as we'll say near the end of this section, go talk to a professional and make it really a tax planning endeavor to help you minimize your taxes. It's a little beyond this course. Okay, auto depreciation. One of the reasons it's so complicated is there are different limits and rules for many different types of vehicles. So let's go over these real quick. There's different rules and limits for luxury vehicles. You'll be surprised by what a luxury vehicle is. That's most vehicles. Passenger vehicles, trucks, vans, and SUVs. Heavy trucks, vans, and SUVs. And then finally, specialty trucks and vans. All have different rules. And these rules are dictated under IRS Code Section 280F, for those of you who are taking notes on code sections. All right, depreciation limited. This is where your depreciation is going to be limited. This is going to be if the vehicle that you purchase is fair market values over $15,800. Now this is for 2014 because these numbers change. And the gross vehicle weight, the GVW of that vehicle, is 6,000 pounds or less unloaded. So that's passenger vehicle or car, unloaded weight of 6,000 pounds or less. Your depreciation is going to be limited. Also, it's going to be limited if you buy a truck, van, minivan, or an SUV built on a truck chassis that is a fair market value of over $17,300 and a gross vehicle weight of 6,000 pounds or less loaded. So that's loaded weight versus unloaded weight. So as you can see, you really have to dig into the type of vehicle you're purchasing to know even how to apply these rules. And oftentimes in preparing taxes, you'll ask your clients about the type of vehicle they purchased, and they'll have no idea. So then it's on us to look up all this information regarding their vehicle to see what qualifies for what and what doesn't. So for the type of vehicles I just mentioned, your bonus depreciation is limited. It's very limited to a certain amount. It's not horrible, but it is limited. Your 179 expense is also limited, and and remember, 179 expense, to claim it, you're only going to be able to claim 179 expense if you purchase the vehicle for business during the year, and that's either a used vehicle or a new vehicle. If you have a vehicle, now it doesn't apply to either one of these, just kind of bonus depreciation either. If you have a vehicle, say you just got into real estate business and you're using the vehicle that you owned before you got into real estate, you can't claim either one of these on that vehicle. You can't claim 179 or bonus depreciation. Let's say, for example, your spouse has a vehicle and you decided, yours broke down, you decided to use his or hers. Guess what? You can't claim 179 or bonus depreciation on it either because you actually owned the vehicle before that. So it doesn't work on a converted vehicle for personal use. Now, depreciation's limited, but not as much, so depreciation is limited a little on trucks, vans, and SUVs over 6,000 pounds gross vehicle weight. So if the truck, vans, and SUVs over 6,000 pounds gross vehicle weight, you don't really have a depreciation limit anymore. Your bonus depreciation is also not limited if it's a new vehicle. And the 179 expense is limited, but it's up to $25,000. And again, that's if your vehicle is purchased for business. So if you have a qualifying vehicle you use, you purchase during the year, and it's an SUV over 6,000 pounds, you may be able to really write off a good bit of that. And you can combine the two. That's why I want to see a professional to maximize this deduction. There's kind of an art to maximizing it. Okay, depreciation, no limit. There are certain vehicles that have no limitations whatsoever, and we'll go over those. That's a truck, van, SUV that's over, truck, van, or SUV, and it's not passenger vehicles, over 6,000 pounds gross vehicle weight, and it meets one of, there's more criteria than this, but I'm only putting the ones that maybe a realtor could qualify for. Probably not this one though. It's designed for 9 or more passengers behind the driver's seat. That's not a van, that's not a minivan. That is really like what you call a mini bus that doesn't have a passenger seat beside it. So you have the driver, you get into the van, and then you got 9 or more passengers behind the driver's seat. That's a specialty vehicle. Think like a little mini bus or a van that's designed to, you walk up in where the driver is there. This is what's going to help most realtors out or most business owners out. This is if you have a truck with a bed length of at least 6 feet inside the bed. That will also qualify for no limit. It just goes by regular depreciation rules. It qualifies for everything. However, the interior length of the bed, which means most of you, if you're in real estate using your vehicles for real estate, you're probably going to have a 4-door truck if you're taking folks around to look at properties and whatnot. So you may have a shorter bed than that. So that's kind of why they made this rules, because they want it to be used more of a commercial capacity. But if you do have a truck that you use for business, 6-foot interior length or more, qualifies for no depreciation limits, bonus, and 179. Certain vans where the driver is completely separated from cargo. Think like a box truck, or basically a U-Haul, that sort of thing, where you have a passenger sit up front, usually just one bench seat, and they're completely separated from the cargo in the back. You've got to go through the back to open it up. That's what this means. So those types of vans are really limiting themselves to commercial use, not personal use so much. They are no limit on the depreciation as we discussed it. Okay, 179 expense and bonus depreciation amounts limit and change regularly, as I've said. So they do change, and the rules don't change so much about what qualifies or doesn't. They do change a little bit, but it's generally the amounts. There may be no 179 one year. There may be no bonus. It depends on what Congress does with a certain tax package that year. So and oftentimes we'll make it retroactive, which means January, I've had this happen a couple of times, January the following year, the Congress will pass a tax law that actually, and the president will sign it, that actually changes all the rules for the previous year. So it's very hard even for us to keep up on. I'm just trying to give you the basic information that you need and actually help you do a little tax planning here too. Most vehicles are what's called listed property also. Most of the vehicles that I've mentioned here, except for some of the ones that have no depreciation limit, or very little depreciation, they're limited property. Listed property, which basically means the IRS knows that they can be also used for personal use, so they are highly scrutinized by the IRS. Sales and trade-ins can create complex tax issues. That's why I want you to see a professional. If you sell your vehicle, as you depreciate that vehicle, you lose what's called basis. You sell a vehicle for more than what the basis is, guess what? You just had a taxable transaction. Also can happen if you trade it in. You may have a 1030, it may end up being what's called a 1031 exchange. Not part of this course. Fairly complex. And it also, you could possibly be treated as a sale on a trade-in also, but it's still create a taxable event, which if you don't handle properly and the IRS finds out, you may have a little mess on your hands. Depreciation, as I've mentioned repeatedly, the depreciations are based on the percentage of business use for the year. So 80% of the mileage on the vehicles For business, 80% of the regular depreciation deduction you'll be able to take that year. Very important here, however, if you claim bonus depreciation or 179 expense on a vehicle, say you even did it a few years ago, and you decide to give that vehicle, say, to one of your kids, or take it out of business, or use drops of less than 50%, and you still have the vehicle, you may have to recapture, which means basically you end up paying back the tax savings. It's a loose way of saying it, the tax savings from claiming that 179 expense or bonus depreciation. So you need to be very careful with that, and that's again why I recommend getting a professional. Here's some areas, not just getting a professional, but to consult with a professional before you make a purchase decision. Just do that because you can really do some good tax planning here. Consult with a professional also if you're selling or trading in a vehicle. You want to talk to somebody who understands the tax rules with regard to this. Professional can also help you maximize the deduction on a qualifying vehicle for depreciation, bonus, and 179 when it's limited. So there's certain ways you can treat these different aspects of depreciation, bonus, and 179 to actually maximize your deduction. I want you to talk to a professional about that if you're in that area. So, hey, that's it. You made it through the depreciation part of the Overnight Accountant's course on Realtors and Reducing Taxes, and you've also finished the auto section. So congratulations. We're going to move forward with the rest of Schedule C here in the next sections.